most powerful person in the world. That's what many have labeled the chairman of the United States Federal Reserve. The Fed has moved around trillions of dollars in credit over the past year, and with little to no oversight or transparency in the process, Ben Bernanke is clearly a very powerful man. President Obama would like to keep it that way, nominating Bernanke to stay on as Fed chairman for another 4-year term.
Ben Bernanke is a first-rate mainstream macroeconomist. He also is somebody who focused on issues around financial crises, how you overcome financial crises. He did a lot of important research around the Great Depression. On top of that, unlike his colleagues, Treasury Secretary Geithner and the head of Obama's Economic Council in the White House, Larry Summers, Bernanke has not been closely associated with Wall Street, has not made tons of money off of Wall Street. So as a mainstream economist working in this job, you really can't get anybody much better. That said, where was Ben Bernanke when the housing bubble was building up? And in 2005 and 2006, he was chair of the Council of Economic Advisors under Bush. Now, where were his warnings about this dangerous housing bubble? He said absolutely nothing by way of warning. Quite the contrary, he claimed that there was no housing bubble.
Our assessment is that there's not much indication at this point that subprime mortgage issues have spread into the broader mortgage market, which still seems to be healthy.
And I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is mostly a localized problem and not something that's going to affect the national economy.
So Bernanke completely missed, or at least was not willing to speak in public, about what has become the major source of the financial calamity we've been through.
Much of the coverage of the nomination has focused on Bernanke the individual, offering great praise for his response to such a daunting crisis.
As an expert on the causes of the Great Depression, I'm sure Ben never imagined that he would be part of a team responsible for preventing another. But because of his background, his temperament, his courage, and his creativity, that's exactly what he has helped to achieve. And that is why I am reappointing him to another term as chairman of the Federal Reserve.
Economist Dean Baker from the Center for Economic and Policy Research isn't sold. He wrote that reappointing Ben Bernanke because of how he has dealt with the crisis is like giving another command to the captain of the Titanic, based on how effectively he got people into lifeboats. But is the face at the top of the Fed really the story, or is it the institution itself? William Greider, writing for The Nation, believes that the focus on Bernanke has served to distract from the broader, more important discussion. He writes, "The personalized narrative is the standard approach the establishment uses to disarm substantive critics and divert public opinion."
So the overall message is that the problem is not whether you have Ben Bernanke or not, because, again, he's about as good as it is going to get within the framework of mainstream economics and mainstream economic policy. What we need is to shift the terms of the debate away from these people, the people that have caused the calamity. Since when are bankers supposed to be the ones making monetary policy for everybody? Presumably, monetary policy is about well-being for not just bankers, but for working people, for all kinds of businesses, including non-financial businesses. And yes, the Federal Reserve and economic policy more generally has moved decisively over the last generation to favor the interests of Wall Street over everybody else. The Fed has been at the very top of that. The Federal Reserve's own mandate is to achieve maximum employment consistent with low inflation. But the Fed has been entirely obsessed with low inflation and hasn't been at all involved in maximizing decent employment.
Critics of the Fed have advocated everything from increasing transparency to abolishing the institution as a whole. The Fed has been notorious for its secrecy. On numerous occasions over the past year alone, when asked during testimony about the movements of trillions of dollars in credit, Fed officials have either claimed they didn't know the answer or cited the Fed's independence in refusing to respond. As of today, 282 representatives, making up 64% of the House, have co-sponsored Congressman Ron Paul's bill to bring a measure of government oversight and transparency to the Fed.
Ultimately, where we really need some supervision and some earmarks are the trillions of dollars spent by the Federal Reserve. They get to create their money out of thin air and spend it. They have no responsibility to tell us anything. Under the law, they're excluded from telling us where and what they do. So we neglect telling the Treasury how to spend TARP money, and then we complain about how they do it. But just think literally, the Treasury is minuscule compared to what the Federal Reserve does. The Treasury gets hundreds of billions, which is huge, of course, and then we neglect to talk about the Federal Reserve, where they're creating money out of thin air and supporting all their friends and taking care of certain banks and certain corporations.
Bernanke has publicly opposed this legislation.
If the Federal Reserve decided a year from now that because of incipient inflation it was time to raise interest rates, that the Congress would say, the GAO is going to audit that decision. It's going to subpoena your materials. It's going to demand information from the members of the FOMC. It's going to evaluate your decision as a report to Congress. I don't think that's consistent with independence.
Poland believes that accountability measures like H.R. 1207 are a great first step, but don't go far enough.
Basically, we need an entire overhaul of our financial regulatory system. One of the ways in which we start the overhaul is to democratize the process of monetary policy. And the way to start democratizing monetary policy is, of course, open up the operations of the Fed, make them openly, regularly accountable. It's not the only thing, because we can also have an openly, fully accountable system and still have ridiculous pronouncements being made by the chair of the Fed, and we can still have bad policy, as we have had. So we need to do two things. We need to open up the operations, make things more accountable, and we need to completely rethink the process of how the financial markets work, who they're working for, and start making them work for ordinary people.
500 people in central Illinois have attempted just that. They gathered on a Saturday morning with 3 invited Fed representatives and presented the reps with a series of proposals. At the top of the list was a request that the Fed use its influence to push banks to lend to real-life community projects in the central Illinois area, instead of lending to speculative finance.
This is the way that we need to go, because otherwise we cannot get the attention of policymakers at all. We need action at the grassroots. We need challenges like those done at Chicago, and operating through the regional Federal Reserve banks is a good place to do it, because they're supposed to be responsive directly to their communities. So the action in Chicago was a very positive step.